Let's take two couples, same age, same retirement expenses, and same account balances going into retirement. One of them pays roughly $22,000 in tax this year. The other pays nothing. One would think that paying less tax is always the better outcome, but in retirement, that's not always true. In some cases, the couple paying $22,000 this year is actually the one that's going to be coming out ahead because they're choosing to pay tax on their terms instead of having it forced on them later. That's the part most people miss. They focus on keeping their tax bill low each year, and it feels like the right move because, well, they aren't paying anything, and paying nothing feels better than paying something. But what ends up happening is that this often pushes them into higher tax brackets down the road, and over time, this ends up costing more than it needs to. And that's really the issue here. It's not that people are doing something wrong, it's just that the default way of drawing income tends to work against you if no one steps back and looks at the full picture. So what I want to show you is this. There are a handful of structural decisions that determine how your retirement income shows up on your tax return. And once you see them, you start to realize how much control you actually have over what you pay. Not just this year, but over your entire retirement. And if you want to see how this actually applies to your situation, there's a link in the description where we can walk through it with you. Alright, so let's go back to the example we led off with and actually walk through why it can make sense to pay $22,000 in tax this year instead of paying nothing. So in both scenarios, everything is the same. We've got a couple age 60 spending $84,000 a year with a $700,000 home, $1.8 million in RRSPs, just under $400,000 in TFSAs, and about $217,000 in a joint non-registered account. And they both plan to start CPP and OAS at 65. The only difference is how they choose to draw their income. The first couple really doesn't like paying tax, which is completely fair, and right now they're in a position where they don't have to because their taxable income is so low. So they decide to fund their $84,000 of spending entirely from their TFSAs. Because those withdrawals don't show up as income, they're essentially paying no tax. They repeat that strategy year after year. At 65, CPP and OAS kick in, so now they start having some income. And by that point, their TFSAs are largely depleted. So they move on to their non-registered account, and as they draw from that, capital gains start to show up on their tax returns, so their income slowly builds. They keep doing that until 71, and then things change pretty quickly. The non-registered account is mostly used up, and now they're forced to draw from their RSPs. The following year, the RRIF minimum kicks in, and their income, as well as their tax bill, jumps in a pretty meaningful way. If you look at this on the graph, you'll see that taxes are basically zero early on, then they start to creep up a bit at 65, and then later in retirement they spike. Now to be clear, this couple still ends up in a good position. They're not making a mistake that ruins the plan, and they finish with an estate valued at about $3.4 million after tax. But the path they took to get there is where the inefficiency shows up. Now compare that to the second couple. They also don't like paying tax, but instead of trying to minimize it each year, they're looking at it over their entire retirement. So instead of starting with the TFSA, they begin drawing from their RSPs first. But they're not just pulling money randomly. They're very deliberate about it. They aim to keep their taxable income below $58,000 because going above that would push them into a higher marginal tax bracket in Manitoba. So they use those RSP withdrawals to cover their spending, and if there's anything left over, they cycle it back into their tax-free savings account. As a result, they do pay more tax in the early years, you'll see that right away on the graph, but their income stays much more stable over time. They avoid that big spike later on, and more importantly, they're gradually reducing the size of their registered accounts. So when we include the tax bill at death, which is really where this shows up, the difference becomes clear. In the first scenario, there's still a large RRIF balance left over, which gets taxed all at once upon death, creating a significant final tax bill. In the second scenario, most of that has already been dealt with along the way, so there's very little left to trigger. And when you add everything together, not just the annual taxes, but the full lifetime tax, the second couple actually comes out ahead by about $450,000 in after-tax estate value, finishing around $3.85 million. So even though they paid more tax early on, they ended up paying less overall, and that's really the point here. It's not about how little tax you can pay this year, it's about how much you end up paying over the entire retirement. Another one I see all the time, especially when people get into their mid-60s, is how they're pulling money out of their RSPs. What often happens is they'll keep everything as an RSP and just take withdrawals as needed, which on the surface feels fine, it's flexible, it works. But what gets missed is that once you turn 65, RRIF income can be split with a spouse, and RSP withdrawals cannot. So you end up in a situation like this. Let's say one spouse has the RSPs and pulls out $90,000 in a given year, and the other spouse only has about $10,000 worth of income. That higher income spouse ends up paying somewhere in the low 20s in tax, while the other spouse is barely paying anything. So as a household now, you're paying around $21,000 of tax. Now compare that to if that same $90,000 was coming from a RRIF and it could be split with the other spouse. So now each spouse reports closer to $50,000 of income, and now their combined tax bill is closer to $16,000 to $18,000. So you're saving roughly $5,000 a year just from that one change. And again, nothing about the first scenario feels wrong when you're in it. The money's coming out, the taxes are getting paid. It just ends up happening in a more expensive way than it needs to, because that income gets concentrated on one side instead of being spread out across both spouses. Another one that doesn't necessarily show up on your tax return right away, but has a big impact over time, is how the portfolio is actually structured across your accounts. What I'll often see is people running the same investment mix in their RSPs, their TFSA, and their non-registered account. So just kind of spread out evenly. But this ignores a pretty important detail, which is that not all accounts are treated the same way from a tax perspective. So if you take a step back and think about it, your TFSA is the one account where none of the growth is ever going to get taxed. Not today, not later, not on death. So if you already know you're not going to be touching that money for a long time, that's usually where you want your highest growth assets sitting. On the flip side, your RSP is fully taxable on the way out. Every dollar that comes out of that account gets added to your income. So in a lot of cases, it actually makes sense for that account to be a bit more conservative. Now, when people first hear that, it can feel like you're lowering your expected return, and in a way you are inside that account. But what you're really doing is shifting where the growth happens. So more of it shows up in the tax-free environment and less of it gets exposed to tax later on. And over a long retirement, that can make a meaningful difference to what actually ends up in your pocket after tax. It's just another example of how the structure, so where things sit, not just what you own, ends up driving the outcome over time. So if you zoom out from everything we just went through, the big takeaway is this. It's not about trying to pay as little tax as possible in any one year. It's about deciding when and how that tax shows up over the entire retirement. Because those small decisions, the order you draw from your accounts, whether you're splitting income, how your investments are positioned, they don't feel like big decisions in the moment, but over 20 or 25 years, they add up in a pretty meaningful way. And the tricky part is the more expensive version of this tends to feel completely reasonable while you're doing it. The income's there, the bills are paid, nothing looks off. It just ends up costing a bit more than it needed to along the way. And for most people, that difference only really shows up when you take a step back and look at everything together. So if you're watching this and wondering how your plan is actually set up, whether you're smoothing income out over time or inadvertently pushing it into those higher tax years, that's exactly what we help people figure out. There's a link in the description if you want us to look at your situation and walk through it with you. And if you want to go deeper on one of the biggest tools we use to control taxable income, TFSAs, the next video breaks that down in a lot more detail. I'll see you there.